Well, good morning, everyone. This is Elliot Kallen with Prosperity Financial Group. I'm the CEO here, and I am very, very excited to tell you this is episode number 7 of Meet the Expert. So welcome to our show. We're getting a fantastic response from people out there, and we've upgraded it here, and hopefully I've added more color to my face because we've got new cameras. I've got a microphone to my right. I've got following the Spaceballs advice. Make sure you're doing the right merchandising. I've got a wine bottle over my right shoulder, over my left shoulder that says Prosperity Financial Group. And I've even got my Prosperity cup, so I feel like I'm on Good Morning America. So welcome. This is a series that we're doing ongoing. It started because of what's going on with COVID and people locked in place. We're going to continue this because we're very effective with it. We are going to rebroadcast this on our website. So we're great. We're happy to have you here. So today, our friends from Goldman Sachs, Brian and Ronald, are going to be talking about first what's going on in the global marketplace, because we're so wrapped up with what's happening in the U.S. that we forget that there's an entire globe happening, global events around the globe. So we've got that, and then Ron's going to talk about cybersecurity. I've asked him some questions about if we're at some type of Cold War with China, and certainly Cold War with Russia, and they're all over our identity. What do I really have to be concerned about? Is everybody on my identity? I'm signed up to all these websites. I'm on my cell phone in so many places where they can track where I'm going, what I'm doing. There are no secrets anymore if I've got my phone with me. So these are good questions for cybersecurity that everyone should be concerned about. Coming up in the next few weeks, I'll tell you that next week, we've got a program called Savvy Women Make Smart Investors. So pass that word around to all of your savvy female friends, savvy women, that's great. And we're also going to have next week a little bit about behavioral science, behavioral finance of mind over markets. The following week, we're going to bring back Social Security. That was a great topic. I keep getting questions all the time about Social Security. And then we're also going to bring up the subject of Wall Street versus Main Street. What's really going on there? Following week, we're going to bring up a little bit more about behavioral finance, how people think about their investments, because there's a reason why so many investors are selling at the wrong time and buying at the wrong time. And then later on in July, we've got an estate attorney coming on, as well as a little bit about Dress for Success. And Corinne will come on and talk about how professional we can look nowadays in this world of super casual happening. So we are Prosperity Financial Group. The website, if you want to take a look at us, is www.prosperity, F like financial, G like group.com. My email address is, and you can send me emails anytime, is Elliot, that's ELLIOT, just one T, at prosperityfg.com. Send me an email anytime. We've got lots of advisors in our office that can help you. Emmett and Jamie are just two of them that come to mind, but we've got several in here that can help you. We are a mid-sized financial services firm growing every day. And we have been able to grow during this pandemic, which is wonderful because the industry has not grown. You can see behind me, if people want to get to know me a little bit, you see some sports things behind me, you see some family pictures behind me. You now can get a pretty good idea about who I am and what my personality is. So let's get going here, and then we'll take questions. Brian is going to introduce Ron, and after he does a little bit about the global marketplace. Again, they're from Goldman Sachs. Everybody here knows about Goldman Sachs, one of the largest was investment banking firms in the world. Now they're just one of the largest banks in the world that does investment banking. That got changed in 2008. And feel free to ask questions. So Brian is one of those people that we call a vendor or a rep or somebody who calls on us and brings us information that Goldman Sachs can bring to us. So we are his client. That's important to know. And so we think that Goldman Sachs has some very good products. We don't think anybody has all the answers out there. And that's why we use 2 or 3 or 4 ideas from Goldman or from JP Morgan or from American Century or from Fidelity. We shop the market. We want to bring you the all-star lineup all the time in our portfolios. We did recently tweak our portfolios. If you're a current client of ours, you know that we have positioned them for the 4th quarter of 2020, not the 2nd or the 3rd. Well, we're right now in a bit of a V in the economic world, which means the marketplace, I'll use my hands, went down dramatically in March and April, and we're made some dramatic, not all the way up, but some dramatic recovery. That's what's called a V. I believe we're going to have some form of a W, meaning that we still have, in July, once the reports come out of what's going on in the second quarter, which stinks, we'll have a little bit of a pullback, and then we'll start the nice road to recovery. So we're positioning ourselves to be in a road. So now you've just learned some economic words of V, then W. I can't do a W with my hands. I feel like I'm in University of Wisconsin doing a W here. And then you never want to have an L. L means 1929 to 1946. That's a bad place to be economically speaking. So we don't think we're in that. Protesting aside, violence aside, lots of crazy things happening in the US right now. But we think from a financial side, we are basically moving in the right direction. The bond markets are still not quite right, but the stock market has improved dramatically. So Brian is the vice president of Goldman Sachs. His job is to bring us ideas, to relay what Goldman's feelings are about the markets. And so I'm going to turn it over to Brian, tell you what's going on globally and how they see the markets. He's going to introduce Ron, who's going to be talking about cybersecurity and what we all ought to know to protect ourselves, our family, and our friends. So Brian?
Thank you, Elliot, and thanks to all that are able to participate today. We truly appreciate the opportunity to share some of our thoughts, first on the global equity markets. Obviously very interesting times and scary times for a number of reasons, and we'll give you our perspective there. I'll have about 15 minutes of commentary. Then I will introduce my colleague Ronald Muhammad to talk about the cybersecurity space. So we'll provide a little bit more detail on that aspect of the presentation when we get there. But to address Elliot's comments up front, I think Elliot couldn't have said it any better. I think really interesting and challenging times at the same token in this world, in this market, and in this country. And I think as we've seen violent protests break out across the United States over the last week, we've seen coronavirus fatalities globally continue to climb. We know we have economic challenges in front of us as we see if we're able to restart economies and get people's jobs back and allow small businesses to stay solvent. Many moving parts, and the data is very fluid. And so my goal here in the time that I have with you is to first help you understand maybe the dislocation of the market relative to global economies and why the market has recovered to the point it has. But then more specifically to Elliot's goal today is, what do we see in the global equity markets? Where do we see opportunity? Where do we see concern? How are we recommending positioning as we move forward? And so with that, I think it's worth taking a second to understand where we've come from. Because if you go back to the March 23rd lows of global equity markets, if you think about what we had at that point, we had very little as it related to factual data that helped us understand how we would overcome the COVID virus. So to quickly retrace, we had no monetary policy on March 23rd. We had no fiscal policy. We had yet to mitigate the curve in hotspots like Italy, Spain, and more locally in New York. We didn't yet know if social distancing could help mitigate the virus curve and help protect our hospitals and frontline workers. Post March 23rd, which is when we've begun to see this equity market recovery. And to put this equity market recovery into focus, the equity markets have recovered more than 35% since the lows. So this is clearly a significant bounce. Some of that left tail risk, and when we say left tail risk, what we mean is, what is some of the drawdown risk to the market? Can the markets get substantially worse from where we sit today? And on March 23rd, when we didn't know the response from the US Fed, we didn't know the response from the government, we didn't know how social distancing would work, and we hadn't yet seen any sort of health policy response as it related to treatments or vaccines, the reality was, in late March, that left tail risk, the downside risk to the market, was quite wide open, meaning there was a number of range of outcomes until we started to see some of the facts come through. And you look at the market today, again, with a 35% recovery in the US markets from the lows, we're only 8% below all-time highs. How have we gotten here? Well, first, the fiscal plan, more than 4 trillion, with more than 1 trillion yet to come. To put that into perspective, the fiscal plan is 4 times the size of the plan that we got in 2008. So very large, but we would also say probably better timed. In 2008, we had to wait weeks and sometimes months for data to deteriorate before we got the government policy response. Now, in some cases, we're waiting days, not weeks or months. When you look at the monetary policy response, the US Fed, at its peak a couple of weeks ago, was buying north of $60 billion in treasuries and high-quality fixed income instruments every day. In 2008, they were buying $120 billion per month. And so the scale and scope of the government policy and US Fed policy has definitely removed some of the downside risk to the market. And that was the initial recovery that we saw. And so I give Elliot a lot of credit because Elliot made these changes weeks ago, and taking a look at Q4 right now and using that as your guide to how to invest is critically important because the markets are always forward looking. And that's why right now you see this dichotomy where the economic data is the worst we've seen in our lifetimes. US S&P earnings are going to be down over 30%. GDP growth, so how fast the economy is growing or shrinking, our economy will have the worst quarter over quarter growth in our lifetimes in the second quarter. Yet, so how are these markets recovering? So clearly one side is the fiscal and monetary. Another big driver is we have now seen that social distancing is beginning to work. We have begun to mitigate the curve in those hotspots I mentioned. In Europe, it's Italy, Spain, Germany are showing signs of now reopening their economies. Clearly in the United States, pockets of our country are already starting to reopen. And why you're seeing the market continuing to rally is the early signs of data, with Europe now opening over a month ago in some of those countries, is we are still seeing an increase of deaths globally. But in these countries that have already been hit pretty hard, that have mitigated that curve, they are able to now reopen, and we have yet to see hospitals be overrun or be overwhelmed. And so these are all positive signals. And so one of the biggest questions we're getting at Goldman is, how are global equity markets recovering, yet we feel like the economy is still in a really shaky place? And the number one driver on that, again, is these markets are always going to be forward-looking. And so rather than the market pricing on economic data as it looks today, what the market is pricing is, historically speaking, pandemics are an event-driven risk. And when we say event-driven, it is a moment in time. And so there's different types of bear markets, and Elliot used letters, right? So a V-shaped recovery is an event-driven recovery. It's one that goes down very sharply, but then recovers very sharply. To date, that's what we've seen. Now, Goldman believes this is an event-driven bear market. Historically, every pandemic has proven to be that, where it's a 1 to 2 quarter serious economic slowdown before then you get a pretty swift recovery. And so that is still our base view, but we would also say where we're at right now, just because we've seen this market recovery does not mean we're out of the woods. And so as we look forward at what we need to continue to see for markets to recover and economics to recover are a few different things. One, we need to see that economies can fully reopen. So one of the questions right now is, can we reopen at a 50% level, a 70% level, a 90% level before hospitals get overrun? So that is something that, candidly, we're not going to have those economic data points for a couple of months here. And so there's going to need to be a little bit of patience with the data to see how this plays through. But again, markets are forward looking. So we're not going to have the economic data. The market isn't going to wait for that. And so part of the reason you're seeing rallying in the European markets is those economies, again, have started to reopen earlier than the United States with some success. It's also why you've seen the Chinese equity market hold relatively well, is those economies have already reopened and we're seeing economic activity and data come back in. And so that for us is what we're seeing right now. But beyond the reopening of economies, the ultimate driver on our markets not needing to look back is an effective treatment or an effective vaccine, or ideally multiple treatments or vaccines that come out of the private healthcare and pharma sector. And I can tell you as a firm, we've done a number of calls with the head of scientific research in Johnson & Johnson, the CEO of Roche, a number of biotech companies and their leadership. And I'd say the overarching response that we're hearing from the medical community that Goldman Sachs research agrees with is that we have moved substantially faster in working towards treatments or vaccines than we have on this virus than we have on any virus in history. Historically, it takes at least 12 months to get to a human trial. As of today, we have 10 human trials ongoing globally, some of which are in the second or third stages. And so this doesn't mean we're at a treatment or vaccine, but it does mean we're much further along the path than we normally are at to date. And so what's very different about this bear market than 2008 is in 2008 at this point, 6 months into the bear market, the conversations that Elliot and I were having were around, will the banking sector survive? Will the financial universe look like it has in the future as it has for the last 100 years? The conversations today are very different. When it's a pandemic-driven bear market, the day we get a vaccine or treatment, the markets are not going to look back. And so as we look at things today, we would say there is asymmetric risk to this market. With the S&P 500 at 3,000, that is Goldman's year-end forecast as of right now. And so that's where I give Elliot a lot of credit in moving into equities and more risk assets about a month ago. Because again, if you wait for the economy to be on stable footing, the market will already reflect the stability that's now in the world. And so I think that gives you a little bit of background on what we're seeing. To share a couple of slides on how we think about investing in this market, I'm going to bring up this chart here for you. And let me get to full screen. And so I think first, one of the major convictions that our firm has when you're in highly volatile markets is you're never going to time the bottom. And when markets are volatile, it typically means they're a little bit scary. It means you have things going on in the world that can cause uneasiness. And so again, I think this is where working with somebody that you trust, one that understands your financial needs and goals, is critical, because everybody has a different risk tolerance. But I'd say where Goldman has tremendous conviction is we're not going to time the bottom. And if this market does give back some of these gains, we're not going to time the next bottom either. But we do have conviction in gradually putting money to work over time. And so this deck was published in the middle of April, when volatility was at its peak and we had not yet seen the recovery that we have today. And what I want to share with you is, in bear markets where the market's going down, if you were to invest 15% before the bottom, so let's say you bought today and the market went down another 15%, that certainly wouldn't feel good for any of us. Nobody likes to buy something and immediately see a loss in their portfolio. But if you're a long-term investor, and let's say you have a 5-year time horizon. Candidly, I think most investors have a longer time horizon, but let's say you only have 5 years. And you say, all right, I'm worried about this market. I understand it's cheaper than it was. Let's buy today. And the market goes down 15%. Well, in bear markets, because they're so volatile, if you were to invest and the market goes down 15%, it only takes you an average of 64 days to fully recover those losses, to start then making positive returns for your retirement goals. Again, if you bought into this market and it drops 15% before the bottom, it takes you a grand total of 2 months in your long-term investment horizons to make up those losses. If you're 10% early from the bottom, it only takes you 2 weeks to make up those losses. Now, let's say that you have cash, you haven't put it to work, and the market just keeps chugging along. What we would say on the recovery, and this is not illustrated here, it works the same way, is you want to gradually put money to work. Doesn't mean you have to do it today. Elliot, I'm sure would have a good strategic plan for you. One of the plans for Goldman right now is, because at these levels, we think you could see the market appreciate about 5% higher if you continue to see economies come back online. But we would argue that if things get choppy, let's say we can't open economies as fast as we want. Let's say we don't get to a treatment or vaccine as quickly as the market expects. We could give back some of these returns. And right now we'd say there's around 10% downside in the market and about 5% upside. That doesn't mean you just sit on the sidelines. Because again, about a month ago, when we didn't have as much data, we were saying the same thing then, candidly. We saw some upside, but there was still significant downside risk. And so there's always going to be downside risk in a bear market. But the one trade we worry about, if you are in a lot of cash, is the action of doing nothing. Because if we sit here and we wait until Q4 and you're not invested, what we know is you're going to miss all of these returns on the way up. And so for us, it's critically important in bear markets not to try to time the bottom, but to look for these gradual reentries on the way down as well as the way up. Now, specifically, what are we buying right now? You can skip theme 2. This is more on fixed income. What I'm going to highlight is this chart in theme 3. And so Goldman believes right now, rather than buying the entire stock market, rather than owning every stock, we think you want to be picky. We think you want to have skilled stock pickers that are focusing on the right types of businesses to own. And in an environment where, and you're going to look at the orange section here, but we're in an environment where we have low growth, and right now around the world, we have low growth. The United States has actually been in a low growth environment since 2007. We also have low inflation. We've had very little price inflation going back to, again, about 2007 when this last bull market started. We have very little in the way of earnings or profits coming out of corporations. Importantly, we have positive profits, we have positive growth, but it's quite low. And we also have interest rates. We have bond yields that are quite low. And so in your fixed income, you might not see the same cash flow that you have. This is why interest rates are quite low to spur economic growth. But what's really interesting here, if you look at these traits, and then you look at them from 1929 to 1940, in environments where the world is growing slowly and company profits are growing slowly, there is a premium put on growth companies. Growth companies, technology, a lot of biotech or healthcare. These are companies that tend to access debt markets. So when you have low interest rates, that means it's cheaper to access debt, which allows you to grow. And so in this environment in orange, which we believe we will be in, even coming out of this bear market, that tells you that we are leaning more into growth than we are into value right now. Now, what's interesting is over the last 3 weeks, you've actually seen value outperform. Now, why has value outperformed of late? Well, look at this middle box when you normally see value lead. You get high growth, high earnings, high inflation, and high rates. Well, we don't see any of that happening in the foreseeable future. This is why for the next, call it, few years, we'll be leaning into growth. But you don't want to lose sight of value. For one, value stocks are much cheaper because they've been out of favor. But also right now, why is value moving? Well, value is moving because economies are getting on more stable footing. And what you're seeing is you're not seeing a breakout in growth that we think holds for a long period of time. You're seeing a reversal in growth. you're seeing really challenging growth numbers in February, March, and April that are now getting on slightly more stable footing. And so you might get these short spurts of recovery and value, but in terms of long-term secular drivers, we continue to believe growth stocks will be in favor. Next, what types of companies do we like? Well, if you look at this top chart, what we are showing you is weak balance sheet companies relative to strong balance sheets. So what are the companies that have revenues that can support their debt? What are their companies that have diversified revenue streams that aren't reliant on one type of client? And even more important in this environment, coming out of the COVID virus and this pandemic. I mean, think about yourself. Are you going to act the same way you did in January as you do today? Are you going to buy the same products that you did in January? The reality is, you think about the hospitality space. How likely are you to see a full restaurant and feel comfortable going in until we have treatments or vaccines? You think about businesses that are brick and mortar relative to those that sell online. How sustainable is a brick and mortar business relative to one that has multiple revenue streams coming through the technology world via online and things of that nature? This is where it means not buying the stock market and buying the company. There are some amazing companies out there that are going to be well aligned with consumer interests and well aligned with how the world is going to work. And there are going to be other companies that are companies we have talked about and heard about for our entire lifetimes that don't survive. So it's going to matter what you own, but what we focus on are these higher quality businesses that, God forbid, if this virus does peak back up in the fall, if it mutates, and if our hospitals do fall under pressure, we are maintaining focuses on those businesses that we think will be resilient. And then lastly, as we think about global, because I think, here in the United States, especially given how the S&P 500 has largely outperformed every index around the world, I think it can be only natural to say, why are we buying all this other stuff? Why don't we just buy S&P 500, some technology stocks, some good pharma companies, and call it a day? And you know what? Looking back at history, you might say, hey, that's the right trade. I think what we would say is, we still are big believers in the US stock market. By no means are we saying to shy away from owning the blue chip companies that are driving our economic growth, i.e. largely in technology. But I think what's interesting, if you look at this chart, this is looking at an index that is called the MSCI ACWI. To explain what that is, this is a world stock market index that incorporates US stocks and foreign stocks. And what we did was we looked at it and said, all right, we understand the US index has outperformed the foreign indexes 9 out of the last 10 years. So i.e. the US stock market has beaten foreign stock markets 9 out of the last 10 years. But what if you said, rather than buying the foreign stock market, we're going to pick stocks in the foreign market. We're going to be much pickier. We're not going to buy the whole market. We're going to buy 40 or 50 stocks that we truly believe can work in the environment moving forward. Well, what's interesting is that we did on this chart, in 2019, we know the US market did better than foreign. Pretty shocking that of the top 50 stocks in the world last year, 90% of them came outside of the United States. In 2018, out of the top 50 stocks, 78% of them outside of the US. You look down this chart, only 1 year out of the last 10 years have more than 50% of the top 50 stocks come from the United States. And so in terms of your overall portfolio, you're going to have a lot of exposure to US, and we wouldn't move away from that. But when you have some of the best return drivers at the single stock level coming out of the foreign markets, we think you want some exposure there. And so that's our view, is you want a global portfolio, but at this time, We don't think you want to own every market. We think you want to be pretty thoughtful about what you buy. And so for us, that's still leaning into high quality growth companies. And we would absolutely make sure you have a foreign footprint here. And, as Elliot said, and then I'll introduce Ronald and move into the cybersecurity, but I think to end, Elliot made a great point on what they try to do is, they talk to a lot of the best asset managers in the world. We're privileged to be invited to that conversation with Elliot. And Elliot and his team do a phenomenal job on picking out some of the best stock pickers and best bond managers on the planet. And, I'll give Elliot some credit here. The strategy he selected with us, one of them falls in the foreign markets. It's a 40 to 50 stock portfolio. Year to date, foreign equities, they're down around 13%. They don't feel great. US equities are down around 8 from their peak. Our strategy that Elliot invests in is down 1%, while foreign equities are down 13. So that's an example of maybe the foreign markets are doing great, but if you have a stock picker that is focused on the right businesses that can be successful in this environment, it doesn't mean you can't have a good experience in your portfolios. So let me stop there with my prepared commentary. Elliot, any questions around the global equity markets before I introduce Ronald?
Brian, I do have a question for you because we get asked this. It appears, that we are in some type of Cold War with China. And so China, the old joke was when China sneezes, the U.S. gets a cold. And so this looks like it's going to go on for some time. We've been in a Cold War with Russia, but Russia's not a big economic trading partner with us. But China is. So how is that going to affect my portfolios and individual portfolios if we're at war with the biggest manufacturing country in the world?
Yeah, look, I think it's a good question, and that's a much bigger question. And this is going to evolve with China, not over the next 6 months, but over the next 5, 10, 15, 20 years. We're really just at the cusp of how do US and China coexist as two world superpowers as we move into things like 5G technology, potentially countries becoming a little bit more nationalistic in the production of supply chains, especially as it relates to, medical supplies and things of that nature. And so, look, you bring up a great question, Elliot. And I think, we're early days there on how it all gets resolved. But I can tell you, at least in the near term, how we look at this is we would expect China and the US in the near term to put their economic and COVID concerns ahead of some of the bigger geopolitical 5G technology concerns that probably get played out over years again and not months. But absolutely, I think as it pertains to, are you comfortable buying in the emerging markets? Does China survive relative to this? The reality is China is a world superpower. They will survive. What remains to be seen is how involved will China and the US want to be with one another? But I think as you look at China and you look at would you want to own companies there, I think it'd be two things to share. One would be China trades a lot with the US, but China's number one trading partner is not the US. It's the collective emerging market countries around it, and it's Europe. And so if the United States decides they don't want to deal with China, to some degree that will slow down China. It will also slow down the US. That won't only be fueled in the Chinese equities you're buying. If the China and the US come to loggerheads, you're going to feel that across global equities. And you could argue, you could see US equities potentially fall a little bit more in the near term, especially as it relates to technology stocks, because US stocks right now are about 50% more expensive than emerging market counterparts. And so I think you're right to be thinking about these issues. And to be clear, we're absolutely looking at these every day. And I think, to say that we couldn't see US-China tensions boil up again this year would be naive. We absolutely could see them boil up as it relates to tariffs, and especially as we get closer to the election on November 3rd. But I think as we look at it, I would go back to what I shared a few minutes ago around, we wouldn't necessarily want to own the index. It's about the right companies to buy. And you look at names like Tencent and Baidu that are on the cutting edge of consumer-based applications that can do banking, that allow people to do shopping online, go down the path. They have some real leaders there that are and that, to us are really interesting names to own. And so I think you want to be thoughtful about how you take your exposure, but we do look at the emerging markets as an opportunity. And I think if you look back at history, when emerging market growth numbers start to outpace the US, and we are on a trajectory, as economies get on stable footing, that emerging markets economies will begin to grow faster again. Historically speaking, you have seen emerging market stocks also recover in a much faster fashion than US stocks or developed stocks when those economies begin to rebound. And so again, I think, as you are very forward looking, as you look at your portfolios, Elliot, what we would say is as economies and EM begin to recover and get on stable footing, you have not yet seen the recovery in those assets. And so we do look at EM assets as being a pretty attractive place as economies get more stabilized.
All right. Well, Brian, thank you very, very much. We've been building portfolios for a while, so we're thrilled to be ahead of the curve. I think we're ahead of the curve. And that's anyway. So why don't you introduce your guest from Goldman, Ron, because we'll take this to another level. I do want to remind everybody, if you need to reach me, my email is Elliot, that's ELLIOT, @Prosperity, FG, like financial group, FG.com. Our website is www.prosperityfg.com. So feel free to send me a note. If you're looking for a text and you want to work by text, it's 510-206-1103. And we'd be thrilled to hear from you. This is episode number 7 of Meet the Expert. I'm joking around a little bit because I've got, remember the Schwartz with merchandising? I've got a Prosperity wine bottle over my left shoulder. I've got a new microphone. I've got a Prosperity cup. I'm having a little bit of fun here. And we're going to go now into cybersecurity. So Brian, would you like to introduce your counterpart at Goldman?
That'd be great. Thanks, Elliot. Yeah, I think, moving away from the markets, we've got a team of consultants inside of Goldman that's done tremendous work for us over the years. And largely what we do is we try to look out there and say, where are risks, where are opportunities, where are areas that our consultants can be impactful in working with our advising teams and their end clients. And so, I'm thrilled today to be able to introduce Ronald Muhammad. Ronald is a vice president in our business consulting group. It is a team of consultants that works globally with our institutional clients, advising network, bank channel. You go down the line, they consult with everybody. And what we've done today is we brought back best practices globally that each and every one of you in your own home, as you think about ways to make sure you're protected, we're going to give you a handful of ways to first check your security, but also then go through and follow up to make sure at the end of this call, you've got some real ideas for action so that you can feel like you're in a good as place on cybersecurity as possible. And so over the next 20, 25 minutes, I'm going to turn it over to Ronald Muhammad to go ahead and walk through some of our thinking as it relates to cybersecurity. Thanks, Ronald.
My pleasure. All right, so let's get this shared with everyone. And hopefully you all can see my screen. All right. That was the first part, making sure all of the technology worked if we're going to talk about cybersecurity. So hopefully everyone here is safe and sound. To Brian and Elliot's point, there's so much going on in our world today. So I'm just hopeful that everyone is safe and sound and healthy during this, global pandemic, and also with much of the civil unrest. So today's session is all about, cybersecurity in a digital and interconnected world. And, we'll talk about a lot of the things that are taking place. What are some of the threats out there, how you can better protect yourself, and then also identify some clear next steps as we walk through this and make sure folks are doing everything they can to protect themselves, but also protecting their family as well. So if you think about our world today, we are completely online, and many of these statistics that you all are seeing are before COVID-19, right? So think about how much time we're spending on our phones now, the amount of hours we're on various things such as YouTube or Netflix or Hulu or input those types of things. Even the way we transact, if you think about Amazon and how that's completely changed the way we shop, how we think differently about, holiday, buying and shopping and what Black Friday versus Cyber Monday means, all of these things are ultimately just changing the way we interact. And taking things a step further, virtually every aspect of our life has some type of virtual alternative, right? And even think about something as intimate as relationships, right? Something that's typically reserved for in-person, face-to-face interactions. Statistics are telling us now that roughly 40% of new relationships start online. That's a staggering statistic. Right. Even recently, actually, I think it was a couple years ago, the 1 millionth baby was born from relationships started on Match.com. So, relationships, marriages, all of these things are changing. And I'll never forget a couple years ago, my mom reached out to me in the most proudest tone you could imagine. Ronald, you're not going to believe who I'm friends with. And so I kind of had an idea where she was going with it. And so I said to her, who are you friends with, Mom? And she said, Oprah. I'm friends with Oprah now on Facebook and we're best friends. And I said, Mom, I'm sure that's not how it works, but go ahead and have your glory. But even on a more serious note, if you think about just the way we interact and we don't have to necessarily travel the world now, literally you can be connected with someone from the palm of your hand. Take this meeting right now. I would love to have been in person and do something like this, but obviously given the times, that doesn't happen, but we still are able to stay connected via these virtual interfaces. But the thing we always have to be aware of is the balance between convenience and security. And so nowadays, most of us have access to all of these different devices. Personally, I think I have about 6 or 7 devices that are always connected to the internet, from my cell phone to my smartwatch to my computer, TV, really you name it. So we have all of these things that are connected to the internet. And the ultimate goal oftentimes with technology is for convenience, to make our lives easier, make our lives more simple. But that comes at a risk. And so we have to constantly be aware of what is being connected to the internet, what are some of the technologies that we have access to, but also what are some of the risks associated with that as well. And so it's this constant balance between security and convenience that you have to constantly be aware of. So let's talk a little bit about some of the threats. And so many of you have seen some of these threats before, but I want to highlight just 2 of them because I think they're critically important for you to be aware of, specifically as it relates to folks, that have wealth and that are investing, because folks, would really love to have your identities in many ways. So number 1 is phishing. And so this comes into play when what appears to be reputable companies reach out to you and ask for critical information. And so you always have to be aware of this. And if you're getting an email asking for your social security number, account numbers, any of those things, it's important to reach out directly to that vendor, directly to that person to see if in fact that's what they want. I'll take myself, for example. I'm in the process of buying a home, and the type of information they want, I'm basically handing over my whole identity. So I'm trying to determine what's the most appropriate way to get you the information, so I'm not necessarily sending it over the internet. Maybe something in person is a little bit more appropriate. So always being aware of what people are asking you and making sure you're doing your own due diligence before you just say yes to something. The other thing is the scareware. And I want to bring this up because I actually have a background in business psychology. And so I just do a lot of research around just human behavior and how they react in different situations. And one of the things that comes up a lot is this concept of fear and greed and this fight or flight mentality that all of us as human beings have. And so scareware really plays on that aspect. And so if you can imagine, if I were to flash something on the screen saying, hey, click this or else your computer is going to fail, or do this to save your computer or whatever, something along those lines, you may quickly select it, right? Because in your mind, instantly, you want to do whatever you think is right to save either yourself or save your information, et cetera. And so those types of things, kind of play on many of the emotions and some underlying psychological concepts and behaviors. And so you have to be really, really aware of those and be cautious with some of those things. And so as you will kind of go through this list, there's some things that are obvious, some things that are maybe less obvious. Just constantly look, where is my digital footprint? Where am I leaving information? Where is my information saved? Where do I have to log into with an email and password, et cetera? Very critical to constantly be aware of those things, because those are entry points. And so a lot of times I compare your digital identity to your home. And so there's lots of doors at your house in terms of people to quote unquote get into. And so it's important to understand what those doors are and then lock them appropriately. And while you can't always stop someone from doing it, there's lots of things you can do to prevent it. And then on the tail end, there's lots of things you could do to correct it if something, were to take place. Let's talk a little bit about the dark web, because this comes up a lot. And so this is more so for information purposes. What is it? How do you access those types of things? So first and foremost, the dark web is a place that you go to really hide your identity and location. And originally, the US Navy actually created software to access it. And the goal was to communicate with each other without being recognized. So obviously it comes from a good place in terms of accessing it. But at the same time, the dark web is typically known for some of the bad and the ugly things that take place on it. Jokingly, sometimes folks call it kind of the eBay of contraband, where you can go there and buy many of the things that you shouldn't be able to buy. But there is some good that comes out of it. Folks have been able to use the dark web to escape, attackers or stalkers or things of that nature, share information to take down, political, oppressive regimes. So those types of things are happening, and that's helpful, and that's a good thing. But the ugly thing is in the event that your information is on the dark web, it can kind of be sold in tranches, based on account value or credit score, and that's the scary part. And so you have to do everything you can on the front end to hopefully make sure that your information doesn't appear there. Now, many of us on this call may not do anything with the dark web, but it's really important to understand what maybe your children are or friends are doing, folks that are in your home that may be using your internet connection, because they may be doing something that could put you at risk and you don't even realize it. And so it's always important to, one, follow these steps for yourself, but also as folks either visit and or you have children around, to understand exactly what they're doing. So I'll pose this kind of quick question to the group. And so as you all look at these two things, number one is, what's the least secure way to make a purchase? And number two, what is the most secure way to make a purchase? The answer to the first question is C, a check, which is the least secure, because there's so much information on a check, from name to address to accounting routing numbers. Way back in the day, folks used to have their social security numbers on checks, but that's not happening nowadays. But again, one of the least secure ways to make a purchase, and one of the most secure ways to make a purchase is through an app, because you have multiple layers of security, from the security at the place that you're purchasing it, the security of your phone, the security of the actual software, that you're using. And then also your account number isn't the same account number on many of these apps. So for example, when I use, apps to make purchases for things, the last 4 digits are completely different than what it would be on my actual credit card. So it's another added layer of protection. All right, so let's get into kind of how to protect yourself. We talked a little bit about what's going on in the world, how our lives have completely changed. We talked a little bit about some of the threats that are out there. Now let's look at what you can do about it. And so as you look at this graphic here, if you think about it, really it's the email that serves as the nucleus for your entire digital life, right? Everything for the most part flows through there. Account information, your calendar in terms of where you're going to be. I have a vacation, hopefully, coming up in a couple of weeks. That's on my calendar completely, and I probably should take that off so people don't know, where I'm going to be. Anytime you need to recover your account, all of that goes to your email address. And for folks on the phone, if you think about it, if you're guilty of this, you're probably not in the minority. But how many folks use a very similar account and password for other things? right? I mean, it goes back to that concept of being convenient, right? I don't know how many times I have to log in using my email address and standard password, but those things really can add up in terms of having additional entry points for your information. And say, for instance, someone does figure out what your user ID and password is to your email address, where else would they be able to get into with that information? And so it's important to make sure, one, you're protecting your email, reviewing the sent messages on a regular basis to see if you're sending messages to people without you knowing about it. That probably means that your email is hacked. And so it's important to make sure you're spending a lot of time making sure that nucleus of your digital life is protected, and you're using best possible password and refreshing that on a consistent basis. And so this next slide can very much be seen as a kind of a duh slide in many ways. If you think about what's happening with COVID-19, they came out and basically said, with everything going on, as crazy as this disease is, the best way to combat it is to wash your hands, right? And so that's how I feel about the importance of password security with many of the things that we have going on. It kind of feels like a wash your hands type of advice. But honestly, it's difficult because all of the different places that we visit, from banking information to email addresses to phone records, kind of you name it, there's passwords there. And so it's really important to take the time to really create a very difficult password that folks can't necessarily guess. So one of the things that I do personally is whenever I have to create a password, I'll use my goals, which are very individual to me. So for example, like I mentioned, my fiance and I are looking to purchase a home in the near future. So there's a certain amount we have to save by a certain date. There's a certain neighborhood that we're looking at. And so we'll kind of make, key phrases and add in, special characters, et cetera. And it's also just a great way to kind of keep at the front of our minds, we don't need to have that extra cup of coffee, we're saving for something, a little bit more longer term. So again, as you think about the way you can protect yourself and create, healthy passwords that are very difficult for folks to figure out, it's going a step, further and doing really everything you can to make that password that's something that is very, very unique. A couple things I'll touch on before I open up for questions here in a few moments. One of the things, folks look at are password managers. Allows you to come up with very unique, complex, and long passwords and allows you to store it in a safe place. There's some reputable companies out there such as LastPass and Dashlane. And some folks feel as though, look, a password manager, if someone were to break into that, kind of have all my eggs in one basket in many ways. And I would, kind of point folks to that, statistic down at the bottom, that only about 10% of Americans use a password manager. So if someone were a hacker or someone were a robber looking to get into your home, are they going to spend their time trying to knock out all the motion sensor lights and everything that's set up in order to protect you? Or will they go somewhere where it's a lot easier to access? And so it's important to do as much as you can to deter these things from happening to you and your loved ones. And the password manager is an option for you to do that. I'll touch a little bit on just general best practices. For those of you that don't have one, I would recommend, getting a shredder, one that offers the cross-cut or confetti, cut type of shredders. You want to make sure you're, visiting the website that has the HTTPS in the website, using credit cards or third-party payment software, so you're not entering in your direct account information. And then just paying attention. One of the things that a good friend of mine does is on a pretty consistent basis, they just scan all the purchases that they made for a month to just see if anything is out of the ordinary. Because a lot of times what they'll do is they'll make small purchases that you really don't even realize. And then those things add up. And before you know it, then a major purchase is made, but all of these smaller ones have been made over a course of time just to see if you're paying attention. The last thing I'll talk about before opening it up to questions is this concept of doxing. And I think it's really, really important right now with much of the civil and political unrest that's taking place in the country. And so in the event that, anyone is on online forums or their children are on online forums, any of those things, you have to be careful what you're saying and how you're presenting yourself. because hackers, in essence, if you say the wrong thing or they take it the wrong way, they can potentially kind of figure out who you are, who your children are, et cetera, and post some of that information in some bad places, and folks could kind of see you as a target. And so it's important to really protect you and the family from this whole concept of doxing, because there's quite a bit of negative consequences that are taking place right now. And in such a politically charged environment, you just have to be careful of those things. So we talked about a lot. You know, you want to make sure you're constantly reviewing your level of risk and identity theft. Just be aware of the different ways that your information could be stolen. Again, do everything that you can to lock those doors, making it difficult for folks to access your information. Make sure you're doing everything around password protection, whether it's using some form of password manager, resetting your passwords on a consistent basis, not only your email, but also the network passwords for your Wi-Fi, you know, changing that on a consistent basis as well. Creating an action plan for protecting really you and your family and being as proactive as possible. So this last slide here, you know, just to start, stop, and continue, identify one or two things you can do differently or even continue to do and be consistent around it is a great way to protect yourself and protect your family. So I'll pause there, turn it back over to Elliot to close us out, and hopefully something I mentioned here was helpful to you, and happy to answer any additional questions folks may have.
Thank you, Ron. I do have a couple questions here we have from the audience, and then we need to wrap this up in the next 2-3 minutes. And that is that there are people who store their passwords and store documents on the cloud. They're not storing them on their computer. So how dangerous is that?
It's a good question. So a lot of password managers, you can do one or the other. You can do something that's a little bit more local, like a program that's actually on your computer, or you can do it on a cloud. And so if you were to do something a little bit more locally on your computer, you can actually disconnect from the internet, access the passwords, and then use them. So that's another kind of added level of security, since you're not directly connected to the internet when you're using it. But if you were to use it on the cloud, I mean, there is some, it is safe. It's not unsafe to do that. It's more so personal preference. The cloud is a lot more convenient, because you can use the same program like on your phone when you're on the go, those types of things. But there is some risk associated with it. But again, at the end of the day, less than 10% of folks are using password managers. And so hopefully, you know, you're setting yourself up to be secure by using something like that.
Okay, and what about PayPal?
In terms of using it in general?
Yes, is it safe?
Yeah, programs like that, I mean, especially an internet company like that, I mean, you're spending sometimes billions of dollars on security in order to make sure that your information is protected. And so whenever you add another barrier or layer between you and the vendor, that's typically a better route to go, just because you're not giving that vendor your specific information, like your account and your routing number. And so things like that, like apps, for example, just add that extra layer of protection.
Great. Well, you've done a great job, Ron. So can we get those slides from you and we'll post them on our website?
Sure.
All right. Well, thank you so much. We really enjoyed it. This was a great session. I want to remind everybody that next week, we're going to be talking about savvy women and smart investors. That's a week from this Tuesday at 11 a.m. Pacific time. And we'll also be talking about the mind over markets, a behavioral guide to making money and to thinking about how to do it. So thank you so much. Have a great day, everybody. And we'll see you next week.
Take care, everyone.